Mortgage rates are on the rise, and they're not showing any signs of slowing down. And the issue has been getting worse. The total value of mortgage loans between $10,000 and $70,000 and between $70,000 and $150,000 dropped by over 53% and over 21% respectively from 2011 to 2021.
Any fluctuation in the housing market affects millions in America. Whether prices go up or down, ordinary families pay the ultimate price. Everybody, including housing market experts, wonders when the housing affordability crisis will end. Given the importance of this subject in this video, we'll talk about the reverse housing market crash in America. But before moving to the topic, consider subscribing to the channel and hit that notification bell. That way, you will always get information on America's most important economic trends. Without any delay, let's get back to the topic. Okay, but why is it a reverse housing market crash? To answer that question, we need to dive into a little bit of history. During the Great Depression, many working people were unable to renew expiring mortgages on favorable terms, which led to the loss of their homes. President Herbert Hoover, who served from 1929 to 1933, referred to this as one of the tragedies of the period. Foreclosures became a critical issue in 1932 when 273,000 people lost their homes. The situation worsened the following year when 1,000 mortgages per day were being foreclosed. This was a challenging time for many Americans. The impact of these events was felt for years to come. During the 1920s, the economy was booming, and prices were at their highest level in the third quarter of 1929. However, this prosperity was short-lived, and by the end of 1932, prices had fallen sharply by 67%. The Great Depression had taken its toll on the economy, and property values suffered alongside the stock market. In fact, the value of high-end properties strongly co-moved with the stock market between 1929 and 1932, indicating the close relationship between the two. So the primary trend was that prices on real estate dropped severely. Now, we observed the same effect during the 2008 financial crisis. In the year 2008, the global economy underwent a tumultuous phase, with the housing market getting hit the hardest. The subprime mortgage crisis, which had at its roots in 2007, caused a massive ripple effect, resulting in a surge of defaults, foreclosures, and rapidly declining home values, not only in the United States, but also in several other countries. The far-reaching impact of the crisis was felt not just by homeowners and borrowers, but also by financial institutions, investors, and governments that had a stake in the high-risk mortgage-backed securities that fueled the housing boom. The crisis shook the global financial system to its core and resulted in widespread economic downturns, leading to many long-lasting social and economic consequences. But just like the Great Depression, the 2008 crisis was characterized by a sharp decline in home prices. Take a look at this. In October 2008, there was a steep decline in home prices, reaching a record low of 18% compared to the previous year. The S&P Case-Shiller Index, which covers 20 major cities, has been reporting losses for 27 consecutive months. Unfortunately, in October, 14 out of 20 cities experienced fresh price decline records. David Blitzer, chairman of the index committee at Standard & Poor's, said, "Home prices are back at their March 2004 levels, and the bear market continues." Sunbelt cities, in particular, were hit the hardest, but most of the country is experiencing a decline in home values. Year over year, home prices in Phoenix, Las Vegas, and San Francisco declined over 30%, while Miami, Los Angeles, and San Diego recorded year-over-year declines of 29%, 28%, and 27%, respectively. With that being said, nowadays the housing market crisis is reversed. Rising home prices are the leading cause of the crisis. If, during the Great Depression and 2008 crisis, families lost a tremendous amount of net worth because their homes depreciated, Today, their homes are at historic maximum. However, this means that millions of households cannot afford a house. Over 44 million American households are renters, to be precise. Nationwide, renters spend around $485 billion in rent every year and still cannot afford a house. Here's the current situation. Owning a house is a common goal for many American families. However, since 2000, house prices have been increasing at a faster rate than household incomes, with only a brief dip during the Great Recession. In order for families to afford a home, they must consider not only the price of the home, but also the interest rate on the mortgage, the size of the down payment, and the annual expenses such as property taxes, insurance, and other fees. It's worth noting that these expenses can vary greatly depending on the location within the United States. Look at this chart. The rate of home ownership in the United States experienced a slight increase in 2022, marking the highest percentage since 2011. As of 2022, approximately 65.9% of households in the U.S. were occupied by their owners. Prior to the 2007-2009 economic downturn, the highest homeownership rate was recorded in 2004. However, the housing market was severely affected by the recession, causing the rate to decline continuously until 2016. Since then, a homeownership rate has started to rebound. Picture looks depressing as we see no progress as millions in this country live by the same standards as decades ago. Families continue to suffer from the ongoing crisis in the housing market. In October, the interest rate on the most popular home loan in the United States increased to its highest level since September 2000. This was the 7th consecutive weekly increase, resulting in mortgage applications hitting a 28-year low. The Mortgage Bankers Association reported an average contract rate of 7.9% for a 30-year fixed-rate mortgage during the week ending on October 20, which was up 20 basis points from the previous week. Moreover, the average sale price of houses sold in 2023 was well over $500,000, more than twice as much as at the beginning of the millennium. Combined with historically high mortgage rates, owning a house stays a dream for millions of workers. According to an analysis from Realtor.com, the United States faces a significant shortage of new homes due to a decade of underbuilding relative to population growth. Specifically, the country is not constructing enough homes to account for the number of people setting up their households. This has resulted in a gap between single-family home constructions and household formations that grew to 65 million homes between 2012 and 2022. However, it's worth noting that this figure overstates the current housing shortage, as new multifamily homes offer options both to buyers and renters. If we include the multifamily construction, which is predominantly rental units, the gap between single-family home constructions and household formations is reduced to 2.3 million homes. Still, the shortage is enormous. Millennials are the ones affected the most. The article by Axios, Why America's Housing Crisis Has Hit a New Inflection Point, offers a more detailed view of the dilemma. The U.S. housing market is caught in a clash between an immovable force and an unstoppable object, resulting in critical affordability crisis. The immovable force is the surge of millennials entering prime child-rearing years and seeking homes, while the unstoppable object is the Federal Reserve, which is determined to curb inflation through interest rate adjustments. This deadlock impacts home builders who face a dilemma: construct houses that buyers may struggle to afford due to high mortgage rates, or withhold construction, exacerbating long-term housing supply issues. Recent data revealed that 11.3% drop in housing starts in August, driven by a decline in both multifamily and single-family units. Single-family home construction is 16% below the average pace from mid-2020 to mid-2022, reflecting a significant decrease in builders' confidence. The spike in mortgage rates since early 2022 temporarily moderated home prices, but by June, The S&P Case-Shiller National Home Price Index rebounded to its all-time high. The peak year for millennial births in 1989 has led to increased demand for housing, creating an affordability crisis. Higher home prices and rising interest rates have drastically increased monthly mortgage payments, contributing to the broken housing market. The core issue lies in over-reliance on interest rate policies to guide the economy. The only viable solution is increased housing supply, which will only materialize if homebuilders are hesitant due to concerns about rates and affordability. Last but not least, when will the crisis end? Let's get back to the JP Morgan article we started with. JP Morgan thinks housing affordability will be restored in 3.5 years if nothing major happens. However, keeping a close eye on the impending recession is essential, as several industry specialists have predicted that the economy may suffer due to increased interest rates. Consequently, a recession is likely to occur sometime in the coming year, exacerbating a reverse housing market crash. Thank you for watching. Hit the like button if you enjoyed the video and let us know your thoughts on the housing market situation in the comments section below.